Welcome back after the break in our Expert Speaks segment. Now I'm joined by RM Vishaka, former Managing Director and CEO of IndiaFirst Life Insurance. With her, we'll discuss a common financial question, mutual fund versus insurance. What is the difference and where should each fit in your financial planning? RM Vishaka ma'am, thank you so much for joining our Insurance Mantra show.
Thank you. Thank you for having me.
Ma'am, now among the Gen Z, the debate is going on about the mutual fund and insurance, and many experts are of view that in insurance, life insurance, one should go for only for term insurance. Other than that, not a single policy is of any use. The returns are very less, and only agents and banks, and they only earn in commission, and policyholder doesn't get anything. So as per your experience, because you were in life insurance industries for many decades, how one should differentiate between mutual fund and insurance product apart from term insurance also?
Excellent. No, thank you so much for the opportunity to talk about this subject. I think since you started with saying the current generation, I think there's another point also. Gen Z. There's another point also there of how people are also now looking at borrowing for revenue expenses, right? I mean, you borrow and then go on a holiday, or you borrow and get married. And so starting your life with a loan. So I think when you look at the situation like that, starting the life with a loan, I think the whole concept of living within your means and saving for the long term have become very alien, okay? Because saving for the long term, think of your future, plan for the future, these are all concepts that align with life insurance completely. Because life insurance is meant to be long-term products. Of course, because of popular demand, all the products started coming down. If you trace the history of life insurance, we used to have a minimum 20 PPTs. Okay, then with the change in lifestyle, with government jobs reducing, private sector jobs increasing, job insecurity, people said, okay, we don't want to make a commitment for a premium payment term for 20 years. So let's reduce the premium payment term. So premium payment terms started coming down to 5 years, 7 years, 10 years, and so on. But the policy terms continued to stay longer. Okay, because the whole objective was save for the future, save for the point in time that you're not going to be earning. Because Anurag, look at our own lives, right? We study for 1/3 of our life, we work for 1/3 of our life, and then you live for another 1/3 of your life on what you have earned in this 1/3 of your life. Mm-hmm. Today, with longevity happening, we're probably going to live even longer. But anyway, I think at a ballpark level, 1/3, 1/3, 1/3 is what it is. So for that last 1/3, when you're not going to be earning, you have to make money, you have to keep aside money from this 1/3. That long term, that guarantees those that you want, because at 75, you would rather have something guaranteed.
Okay.
Okay, so the whole insurance plans differentiate from the perspective that they are guaranteed, they are locked in, and they are for the long term. Compare that with mutual funds, which are not, nobody markets it saying buy a 40-year policy. Nobody says give me an SIP which is for 40 years. Because the whole, it's not intended to be that way.
So now there are few products in mutual fund also, goal-based or target-based SIPs.
That's right. So, and that's interesting, right? Now that they are looking at goal-based, target-based, that means they agree that that is right. So that means the positioning of life insurance for goal-based, target-based, if that's now being mimicked or imitated by mutual funds, then that means that the original positioning is right, isn't it? So that's what the whole thing is. Now, I think the challenge really becomes when people start looking at returns and saying returns is iska nahi hai. And I think, one of the things that I believe should be done is insurance companies need to be enabled to have guaranteed products with benchmark returns. Supposing today we say we have this return, but nobody is able to measure that return. What do you measure it with? Okay.
Ma'am, a lot of queries or complaints about insurance industry is that the latest one I received from a very senior banker. He's a now retired banker and he used to be a deputy MD of a leading bank. He messaged me that, Anurag, I bought a life insurance policy. Every month I was paying 25,000 rupees for the premium I paid for around 10 years, and I paid around 30 lakhs. And now when I want to buy a house after my retirement, the surrender value is around 17, 18 lakh only. So it's a very less, and insurance companies are fooling around with people. Because, sir, that is the surrender value is less. You should continue your policy.
Yeah, that's right. Because I remember this conversation I had once with someone who said, I don't like life insurance policies because they don't have an exit clause. I said, why do you want an exit clause for a policy which you're saving for your child's future? If you are saving money for your child's college education, why do you want an exit clause? You should be saving that for your child, right?
But at times, ma'am, there are few emergencies also.
Yes, the emergencies are very different. That's, I think, exceptional circumstances. But I think that's really not the norm. That's an exception.
Okay. So there are any other factors also which differentiate between mutual fund and life insurance?
So this fundamental factor is that mutual fund is just a pass-through. Mutual fund, you can have 50 crores capital and you can take 50,000 crores of investments. Whereas life insurance, it's not a pass-through. The risk is on the life insurance company. The risk of guarantee, the risk of mortality, everything is on the insurance company.
So other side of life insurance industry, which experts are not speaking, they are just focusing more on mutual fund and term insurance only.
That's right. Whereas, okay, this is the last point and then we can move on to something else. But let's look at buying a house, okay? Every Excel sheet, every calculation will tell you that it is a bad financial decision.
Yeah, obviously.
Correct? Taking a house on rent is a better financial decision than buying a house. We still buy a house.
The emotional connect.
Because at the end of the day, while you don't make emotional decisions about money, money is meant to fulfill emotions. So where is that security? So I'm saying that if you're brave, you don't need security, please, go ahead and invest in the markets. Don't go for it. But there is a certain element of security we all need. Certainly. And that's where...
And in the life insurance also, the annuity part I want to understand from you. The annuity returns are generally 5-6%, which is public at large or those policyholders think that annuity returns are very less. So one should not go for annuity policies after their retirement.
See, I can say I myself bought an annuity policy. Okay, because I was very clear that with all my investments, everything is fine. But my regular monthly expenses, I need that taken care of till my dying day. So I did an estimate of how much it will be. And I said that much annuity I want every month coming in. Why did I do that? Because I recognize, and I can speak for myself, Anurag. I can't speak for every other customer and how they think. Okay, but I realize that as you grow older, your ability to process and manage becomes lesser and lesser. So a certain amount of money locked in, which will give you an income for the rest of your life, is in my way a very prudent way.
What is the ideal return in an annuity product according to you? What should be?
You're looking at guarantees.
Yes.
Correct? So give me a benchmark of a 40-year guarantee and then see if the return is anywhere closer to that.
Okay. It should be 6-7%?
Look at a 40-year guarantee paper. How much it's changing. Look at what the GSEC is today.
Okay.
So I think
I'm asking for our normal viewer. They won't be able to look at a 40-year guarantee product.
I will say that, when you're looking at a longer term and you look at developed markets where the returns have come down to 1% and 2%. I know that, for instance, 10 years back in the UK market, a 3% was considered to be a very good annuity. Okay, I'm not saying that's a great annuity, but I would say I think anywhere between, depending on the age of the customer, depending on the tenure for which that person is buying it, based on all of this, I think it will be anywhere, it should be anywhere with the GSEC, comparable with the GSEC rates.
6.5%.
Yeah, whatever the GSEC rates are.
Okay, so, ma'am, my last question to you, what would be your insurance mantra for our viewers?
What's my insurance mantra? Make very conscious decisions. Okay. don't compare the incomparables. I think this is universal, right? And people will talk about stock tips and say, nahi, mat lo. I'm just saying, be very conscious. Decide why you're saving, why you're picking up this particular product. Try and understand a little bit. You don't have to understand how the mechanics work, but you do need to understand why you're buying it.
Okay, ma'am. Thank you so much for joining our Insurance Mantra and sharing your insight.
My pleasure, completely.
So that's a wrap on this edition of Insurance Mantra, but we'll leave you with our Insurance Basic Did You Know? So an annuity plan in life insurance help you to get a regular income after your retirement. In simple terms, you invest a lump sum amount with an insurance company, and in return, the company pays you monthly, quarterly, or yearly income. There are mainly two types. Immediate annuity income starts soon after your investment, and the other one is deferred annuity. Income starts after a few years. Some annuity plans also continue income for your spouse and may even return the original investment amount to your nominee. So simply put, an annuity plan converts your saving into a steady retirement income. So stay informed, stay protected. That's our insurance mantra.